Okay, good evening, everyone. Greetings. Welcome to Tax Planning for Small Businesses. My name is Rena Bacalar. I'm the Director of Economic and Community Development for the town of Trumbull. I'm sending greetings on behalf of First Selectman Tesoro. She wanted to be here with us tonight. She is unfortunately home sick, so she's unable to attend, and she regrets that because she's actually a tax expert herself, so she was very much looking forward to our program. The town Department of Economic and Community Development partners with SCORE throughout the year to do some seminars, some in person, some online, to support our small business community. This particular seminar is really based on this time of year, tax season, but also on some of the needs of our businesses that they've expressed to us. So we hope you'll enjoy today. We also have the Town of Trumbull Tax Assessor Office that is with us tonight, and they've agreed to share some of their expertise on personal property tax. So you'll be hearing from them a little later in the presentation. So we're going to do a series of just brief introductions so that you understand who is here tonight. And once we're done with the introductions, SCORE will take over the program. I will tell you that we'll ask you to jot your questions down, hold your questions. There will be a Q&A session at the end of this seminar where you'll have the opportunity to raise your hand. You'll be called into the meeting and ask your questions. So we'll do that toward the end of the meeting. Also, for you to know, this meeting is recorded. There will be a link available, so if someone wanted to revisit the information. And Gia, our economic development assistant, will also be circulating all of the materials that you see on screen tonight. If you've registered, she will be circulating that after the meeting. It will also be posted to our Business Resource Center on the Town of Trumbull Economic Development page of our website. We know some businesses here are from Trumbull. We know some businesses are from outside of Trumbull in the region and maybe even out of state. We welcome all the businesses. See, you're not a Trumbull business now, but you might be in the future. So we're the people you call. So we just welcome you because we want our small business community, whether it's Trumbull, the region, the state, or our country, to be strong and have the information that they need to succeed. So this is a part of that effort. And I'm going to turn over the introductions first to economic development, then our tax assessor will do their introductions, and then SCORE will do their introductions and take the program from there. Thank you for joining us tonight, and we look forward to a great exchange of great information and learning. Thank you.
Good evening. My name is Gia Mantillo. I am the Administrative Assistant for the Trumbull Economic and Community Development Department. You've probably emailed with me if you registered for the event. I am happy to send out the materials afterwards, and please feel free to reach out if you did not register. And thank you for being here.
Tax Assessor's Office.
Hi, I'm Lynn Ormsby. I'm the Assistant Tax Assessor for the town of Trumbull. I handle primarily administration piece. I'm on the call also with Rawan Shaham, who will be assisting me tonight.
Thank you, Lynn. SCORE?
Is Rawan going to say anything, or?
Hi, I'm Rawan Shaham. I'm here with the Trumbull Tax Assessor's Office as well.
Thank you.
You're welcome.
Okay, and I'm Tim Ryan, a business mentor at SCORE. First, some brief info on SCORE. SCORE is funded by a grant from the Small Business Administration, so all our services are completely free of charge. There's over 200 SCORE offices in the U.S. with over 10,000 volunteers. Fairfield County's SCORE covers from Greenwich up to Shelton and is one of the largest and highest rated chapters in the nation, with over 100 volunteers comprising a wide range of expertise. We offer 3 evaluated services to small businesses, which are all accessible from our website at fairfieldcounty.score.org. First, we provide free one-on-one counseling. If you don't have a SCORE mentor, why not? They're free. Second, we produce over 100 educational workshops and webinars each year, like this one, on topics of relevance and importance to small businesses. In fact, tomorrow at the Trumbull Library at 6 o'clock, we have a workshop on how networking can help you grow your business. It's something I'm sure we can all benefit from, so I hope to see you there. The third thing we do is we have extensive resources and tools on our website, including templates to help you build your business plan. So with that, I'll turn it over to Joe. Joe has over 40 years experience in accounting and taxes while working in public accounting, small business, and the IRS, where he retired in 2008 as a revenue agent. He also has been an adjunct professor at Fairfield University since 1972 and Manhattanville College since 2008. So Joe, it's all up to you.
Okay, thank you kindly. Am I being heard by everyone? How come I'm not on the main screen?
I do see you on the main screen, Joe, and
Okay.
I do hear you.
Okay, so yes, I'm retired since 2008, and in addition to volunteering for SCORE, I also volunteer for the IRS, and I'm currently doing tax returns for free for 3 days a week. Again, it's an IRS-sponsored program. So what we're going to do here is give you a little checklist to prepare your 2024 returns, where we have approximately 4.5 weeks to do that. So I'll start the slide. So again, this is a webinar that is giving you some tax tips. We don't want you to say that you're going to prepare your tax return because Joe Dageston did this. That's not the purpose of it. If you need some tax help, you could meet me one-on-one. We could take an actual look at your tax return and give you some guidance. Otherwise, your tax preparer or CPA is the person to ask your questions. Remember that your 1040 is really a combination of your personal, business, and investment tax activity. So that's interest, dividends, capital gains. You may have other W-2s, or you may be filing with another person and they have W-2s. So all of that goes into the computation of what taxable income is. The Schedule C, for all purposes, is basically where your business return is going to be prepared. And in a nutshell, it's an income statement. Now, what if you want a copy of the PowerPoint and whatnot, there you can contact Trumbull, or again, let's see. There's my email there, Joseph Dageston at scorevolunteer.org. And again, if you need some help, you can go to SCORE, request me as a mentor, and we can meet online or in person. I'm in Norwalk, and I usually meet people in Norwalk and in Darien. Now, this is was a shock to us all. It's called a BOI report. It was came out January 1st, 2025, and it was given all small businesses a short period of time to file this information. Then they rescinded upon it, and then recently, now it was unrescinded. So every small business person has to do this BOI report. And basically, for instance, you may have the name of your business, Joe Blow LLC. The purpose of this is to find out who really Joe Blow is. If there's one owner, they want the a copy of the driver's license, and the social security number, a passport. They want to know who the owners are. If there are multiple owners, then multiple owners have to provide this information. And there is the link, and there's an instruction in video. I've had a couple of people who have an LLC, so there's one member. They went on there. It took them about 15 minutes to produce the information that was.
Joe, this is Rena Bacalar. I just want to pause for a second. I don't know if anyone else is having trouble, but you're fading in and out in terms of your volume. So I don't know if you can adjust your volume or maybe speak more to this into the speaker.
Into
Thank
the
you.
speaker. Okay. All right. Thanks. Yeah. Just let me. I'm not moving around. I'm right here at a table, so I don't know whether I have problems with my computer, but just let me know if I am going in and out. So that's DOI. Now, this is just a summary of the topics I'll be covering. We want you to review your 2023 tax return. We're going to, excuse me, look at the 2024 standard deductions, which change each year by a couple of $100. There's a new rule on when you can't take charity deduction. We'll describe the pass-through entities that we preparing a Schedule C. We'll talk about self-employment tax, which is very important for small business. It's 15.3% of your profit. There's some rules on taking business losses. We're required for any retired people will cover our RMD. We'll talk a little bit about Schedule D, gains and losses. That's the sale of securities. There's an annual gift exclusion. You have some extra cash and you want to give it to some people. We'll talk about the sale of a residence, and then we'll talk about QBI. Our friend President Trump in 2017, he uploaded and changed the tax code in a lot of areas. In one area was he changed the tax rate for corporations from 35% to 21%. So he did nothing for small business. He did a little. This QBI gives you a little, I'll call it adjustment or reduction of income based on your profits that you make. So it's called qualified business income. So that's what he did for, we'll call us the little guys. We'll talk about a little bit about PET. We'll skip passive activity is kind of technical, but we'll sort of skip that. And the other factors I'll go over real quick also. Now, the first thing you should really do, tax season comes once a year, but tax preparation, if you do it and it makes sense, you're doing it monthly. So we're too far beyond that now. And at this point, you use your 2023 tax return that you already filed as a checklist. And what you try to do is overlay your 2024 items onto the 2023. Many of us, excuse me, are creatures of habit, so the items don't change too much. But now we know in the small business world, the profit and loss statement is going to change year to year. And did you receive a refund or did you pay in 2023? Remember, taxable income is not only determined by your Schedule C, your small business, but other items on your return. So you make a huge capital gain or a capital loss, and that could change the results of 2024. Unemployment compensation is fully taxable. There was a couple of years where it wasn't, but that's fully taxable. And what are the withholdings that you had in 2023? And what estimated taxes did you make in 2023? Did you make the same or less in 2024? If you have your return prepared by an accountant, you should have met with him already. If you haven't, you should meet with him. Now, the business forms that we call pass-through that go to your Schedule C, are Sub S, a partnership, an LLC. And the only one that doesn't go on your 1040, if you are an 1120 C Corp, that is a separate entity. So they file a tax return and their profit or loss stays there. It does not go on your 1040 at all. Okay, moving on. The standard deductions for 2024, single 14,000, married filing joint, if they're under 65, it's 29.2. Married filing separately is 14.6. Head of household is 21.9. There's additional standard deduction if you're over 65 or blind. So if you look down below, if both people are over 65, the standard deduction is 32,300. And since Trump changed and increased the standard deductions from 2017 on, and all his changes expire on 12/31/25. So we're going to see a lot of activity with him and Congress on what they're going to do. And one of the items are the standard deduction. So he'll leave, they expire automatically. He has, I guess, he could leave everything alone. It'll go back to 2017. He could ask Congress to pass all of them through, and he could make some changes. And one of the changes he stated is that, believe it or not, he wants to change the corporate tax rate from 21% down to 15%, but he hasn't said anything about small business. So the pass-through entities, these are what we call the business. Now, the pass-through entity, you could be a sole proprietor, you could be an independent contractor, and then you protect yourself. You could be an LLC, single member, which is a limited liability company. All the types of forms of business, LLC and sub S, etc., you have to go through your state. They're the ones that approve you, not the IRS. And the state has a very good online system that you can do this very quickly. So a partnership, they have to file Form 1065, which is non-taxable, and then they issue a K-1 to each partner to file on their 1040 Schedule E. Sub S, they must file 1120S. It's a non-taxable form, and then their K-1s go to each owner, and that appears on the 1040. So that's what we mean by pass-through. Landlord reports on Schedule E, and note the C Corp, the 1120C, is not a pass-through and files an 1120C tax return. Now, the owners of the C Corp, they participate in the operation of the 1120C. They get paid as an employee. So it's a deduction on the 1120C, and then that W-2 goes to the personal 1040 of the owner. Let's see what we have here. I think this is a little repetition of what I just went on. Yes, it is. Okay, did a little duplicate here, or I guess sometimes I just talk too fast. Now, here's the shocker, especially for people who just entered the small business world. You wear two hats. As a small business person, you're the employee and the employer in regards to Social Security and Medicare. So if you're an employee, you know on your pay stub, you'll have a deduction for Social Security and for Medicare at approximately 7-point-something%. And the employer matches that. So as an employee, 15.3% goes to the system in your name. Now, you're not an employee, you're a small business person, so you wear two hats. So you have to pay into Medicare and Social Security. 15.3% of your profit not your sales, of your profit. If you have no profit, then you don't put anything in. Now that 15.3% is automatic. Now that profit goes on your Schedule C, and that's going to get taxed too. So the limit on this, I have it as 168,600. Then you don't have to pay Social Security and Medicare. But I think it increased this year slightly, maybe about 175. Congress increases it each year due to inflation. So as an example, if you're a small business person and your profit is 100,000, you're going to have to pay 15,300 SE tax. And let's say you're in the 20% bracket, then another 20% on the profit, which is 20,000, or a total of 35, plus in Connecticut about 6.35% tax on 100,000 also. So when you make money, preserve cash. And what you should be doing if you're making money, and if you're doing your running your business and keeping score properly, you should have an income statement monthly, and then each quarter, if you're making money, then you should put in 15.3% of the profit plus about 20% in estimated taxes, so you don't get a shock at the end of the year when you do your tax return. Now, business losses, the business loss offsets other income on your tax return. Now, the 1120C, that's a separate entity, so all profits and losses stay there. It doesn't go on your personal return. Schedule C losses are used to offset other income, no problem. Partners, there's special rules as to what losses you can and cannot take. So you have to go in and look at the rules. Basically, whatever your partnership investment is, you can take losses up to that. If you have a loss and you don't have an investment, or it's negative, the loss is postponed until you have what we call a positive capital account. Sub-less or sub-S losses take the same rules as partnership losses. If you're a landlord, the Schedule E, in general, your loss is limited to 25,000 if your adjusted gross income or modified is below 100,000. If you have losses, again, they are postponed. You can't take them that year if you're in this bracket. If you're under $100,000, then you can take losses up to 25,000, and they reduce other income on your 1040. In 2017, these are the tax changes. The tax rates, standard deductions, state and gift tax, QBI, and more. These are the ones that expire in 12/31/2025. In your Schedule C business, one of the areas that, if you meet the rules, you can deduct the standard mileage rate for business miles. This year, 2024, there's 67 cents. I believe they already said that in 2025 it's going to be 69 cents. Business meals are 100% deductible. There's a couple of online webs that I get, or emails daily, and they're in the small business area. IRS, if you Google IRS tax tips, they come out almost daily, and you just look at them and see if they're applicable, and occasionally they are some interesting articles for small business. Then there's another website by Barbara Whiteman. It's Big Ideas for Small Business, and that comes out daily, and that's related strictly to small business. And just as a reminder, the individual 1040 tax brackets, again, they have different income ranges, but they go from 10% all the way to 37%. I think Trump changed them. There was, before Trump made his changes in 2017. I think it was also a 39% bracket, but he changed that. Now, this is for the older people. If anyone, we do have people still in business, but they're over 73 and in their days. And one of the deductions you can get in a small business, you can start your own 401k. If you're an employee like I was, I have a 401k, so I didn't pay any taxes during my business years. Now, after 73, we have to take money out automatically and pay taxes on that. And it's computed each year on 12/31, whatever the market value of your 401k is, that determines, there's a formula that determines what you must take out in the next year. You have 12 months to take it out. It's not very difficult. And the other advantage of this is that if you wish to give to charity and you withdraw funds and you give it to charity from your RMD, that means that the withdrawal of the RMD is not taxable. So if your RMD, let's say, is 50,000 and you want to withdraw the 50, but 10 of it you gave to charity. So you withdrew 50, 40 was just withdrawn, and then 10 was given to charity, and now you're only taxed at 40,000. So this is an example of the RMD. They had 250,000. Their age was 78. They go to the RMD table, and the factor that they have to divide by is 22. So they divide the 250,000 by 22. Their RMD requirement is 11,363, and they have 12 months to take that out. So the RMD withdrawal, no matter what age, is usually somewhere between 4 and 6%. That's the mandatory. And the financial institution that you have your 401ks, usually in January, they do the computation for you and they send you a letter. I believe it's mandatory that they do that. And if you have multiple RMDs, multiple IRAs, whatever, you add them all together and you come up with the computation, you can withdraw them any way you want. You can withdraw a little bit from each IRA, or you can withdraw it all from one, as long as you meet the total. Security losses and gains are pretty straightforward. It's a Schedule D. Your financial institution will send you a 1099-B, and that's what is input to your tax return. The cost and the sales price are already on there. So it's very simple these days. If your losses exceed your gains, they cannot be more than 3,000 net to be put on your tax return. So if you have losses of, say, 15,000 that exceeded your gains, that tax year you're allowed 3,000, and the other 12,000 is called a carry forward. So you don't lose it; it's carry forward to the year. You can take another 3,000, or if you have capital gains, it will reduce that. The annual exclusion for gifts is 18,000 per person. You don't have to report anything. A gift is never income to the receiving individual. In 2025, it is 19,000. So basically, this is the estate and gift tax rule. So if I give some person more than 18,000, I'm single, then I have to file a form because it goes against my estate and gift tax. When people die today, if their estate valuation their house, their investments, their art, etc., exceeds 13 million per person, they have to file an estate and gift tax. So if I'm giving more than 18,000 to this person, I file a form. I don't pay any taxes now before I die, but it reduces my 13,610,000. Connecticut, the estate and gift tax exemption is only 7,100,000, I believe. What happens is some states just piggyback on whatever the Fed does. Connecticut doesn't, but I believe they're scheduled to reach this 13 million in a few years. And the 13 million, again, that's a figure that changes slightly each year due to inflation. And a grandparent who pays for college, a grandchild college, it's not a gift, it's not taxable, even if the tuition exceeds 18,000. Sale of a residence, that's one of the big benefits of the tax law that hasn't changed. If you own your residence and have lived there more than, I think, 5 years, you sell it. If you're single, the first 250,000 of profit is basically forgiven. If you're married filing joint, then it's 500,000 of the profit. And it's not a one-time thing. If you're sell your house and then you're in another residence and you stay there 5 years and you sell it, the 500 or the 250 comes into play again. And your sale of your residence, even if there's nothing taxable, has to be reported on Schedule D, but there's a special area there for residences, and the 250 and the 500 come up depending upon your filing status, single, head of household, or married filing joint. The qualified business income, that's the area that Trump does, giving small business who have a profit, they get a deduction. It can be as high as 20% of your profit. There's a formula. People use tax preparation software like TurboTax, and it's all figured out on there. The form that is on the 1040, the 8895, that's the form that will come up. TurboTax will prepare that and show you what your deduction is. It's reduction of income. Let's see, what do we have here? This one here, it may have, just let's skip over the PET. This is the corporate. And one thing that our friend Trump did in 2017, that a lot of people, especially in Westport and Darien, that own houses, they pay 15, 25, 30,000 in taxes. If you itemize your deductions, the property tax and the withholding from Connecticut are capped at 10,000. It's called SALT. So what happened is a lot of people who are itemizing, because this SALT was capped at 10,000, before that they may have been deducting in that area 20 or 30,000. They've been taking the standard deduction. So people are not happy with SALT. Some states came up with a tax loophole that enables some of the people to get back some of this money in a small way, but not all of them have done it. Hopefully, the rumor is that SALT expires in 12/31/25. The rumor is it may be increased. The 10,000 may be increased, or the 10,000 may be eliminated and go back to the old method that if you itemize, you can take all your property tax and state withholding. We're going to skip this. One good area, even even for people, you know, the rule for taxes is if you can defer income, that postpones the tax, and you can exceed expenses. You do that. Now, in the corporate world, What a lot of people do if they're going to get bonuses in November and December, the corporation will pay them in January or February, but the corporation gets a deduction. So in your case too, as a small businessman, if you have a heavy third quarter and whatnot, you don't have a chance to do this deferral. Okay, you don't pay yourself a bonus, and unfortunately, you're not in this arena. So there's not much you can do in terms of postponing income. The only thing you can do, let's say for your December sales, you're on the cash basis, or November, you can ask the people, don't pay me so fast, pay me in January. Then that it was considered income for January, even though you did the service, because you're on the cash basis. You did the service in November, December, but they didn't pay it in January, February. That goes into 2025. Now, in your arena here, the situation does come up if you hire someone, is that person an employee or an independent contractor? As an employee, then you're responsible for doing the payroll and collecting the withholding for federal, for state, Medicare, Social Security. You're responsible for doing that, or you hire a payroll service to do that. And at the end of the year, the employee gets a W-2. If it's an independent contractor, you just pay them according to your contract by the hour and whatnot. There's no withholding. At the end of the year, you give that person a 1099. And you have to give the person a 1099 if it's more than 600. That's your support for taking it as a deduction on your return. Now, the IRS has an area where you can ask the IRS specifically, give them is this person an employee or an independent contractor, or you can go through their 20-factor IRS test. There's 20 questions, and the form is called SS8. All right, this is the end here. Almost time for questions, but just sort of a PR. I also volunteer for the IRS, and I've been doing that since 2008. So as I said, I prepare taxes. It's meant to be for small and medium and small income, and everyone has documents, pension, Social Security, W-2, 1099s, but we also do Schedule C on a small basis. So if your Schedule C, let's say, doesn't have expenses more than $7,500, we could do your tax return for you, and it's free. So but what we don't do, if on your Schedule C you have depreciation, that's out of scope. We don't do that. So then we couldn't do your tax return. You'd have to find a CPA or a paid preparer. And we have various locations throughout Fairfield County. The program is called VITA, V-I-T-A. It's nationwide. And most of the sites are by appointment. Now, you can't just walk in and have your tax return done. So that's about it. So I think I'm on schedule here.
So, Joe, this is Rena Bacalar. I wanted to ask you, because you went through a lot of information, but we didn't really focus a lot on things that small businesses should track in terms of their expenses that they can write off. You talked about meals and mileage, but there's lots of other things that they can consider. Can you offer some more tips to our small businesses in that regard?
Well, the IRS rule as to what you can deduct as a business, it has to be ordinary and necessary to that business. So what is ordinary and necessary to my business may not be ordinary and necessary to yours. So the number one rule is that if you're spending money, keep track of it and seek advice as to whether it's an expense or not. Some of the expenses that basically most businesses take, for example, if they're using their computer, if they're using their cell phone, if they're using their car. Those are the most common. If you go to Schedule C, there's a list of items suggesting what might be an expense. Now, they don't all apply to you. You pay for insurance for various things. That's an expense. If you're preparing your income statement manually or with QuickBooks or something, you can call whatever you want as an expense. It doesn't have to tie into that Schedule C. Schedule C has a list of expenses. If you can't find your description, there's something called other expenses, and you put in your own expense item there because you track it that way, and the IRS knows that not everyone uses their terms for expenses. The other expense that comes up, people, there's consulting people, and then there's also people that manufacture or buy a product. So you may have a cost of sales, and you may have to buy products. So you're going to be working with inventory and that aspect of accounting. What else is common? I'm just thinking out loud here. It's not, well, I can't think of, in insurance. I'm just thinking of a person contacted me today, and he was going over his, and I'm just thinking, we talked about auto. If you have employees, the W-2 is an expense. If you have independent contractors, you send them a 1099, that's an expense. Again, you have to prove. We said business meals. I really can't think of anything else. If people have questions, ask. The one thing, so again, it's not expense, but when you do business with other people, you may get some 1099s. You have to report them on your Schedule C as income. Even though it may be in your bank account and you're counting that, they want that 1099 or 1099-C or NEC reported on the return, and then all your other sales that you collected and you didn't get a 1099, then you report that in another column on the Schedule C. If it's an expense, keep track of it. If there's any question, then you ask a professional. The other word is that if you're not sure whether it's an expense or not, take it, put it on your return. You have the proof. Sometimes even a preparer will tell you that they're not sure in this situation. If you don't take the expense, you don't get it. If you don't report the income, the IRS has a way of finding out about your income. They know nothing about your expenses.
Thank you, Joe. I know that, even professional association memberships that might tie to your business area, that's something that I often tell folks to make sure they include. Special training that they may have to take for their industry to keep them relevant or certified, those kinds of things as well.
Yeah, people go to conventions annually for their business or whatnot. The plane fare, room and board, hotel, that would all be deductible. It's the ordinary necessary business expense for you and your business. No question about it. Also, it's not on your Schedule C, but you may want to take some courses on. Let's say you want to take a course on accounting. Well, that's called an education credit. So it wouldn't go on your Schedule C, but it goes on your personal return, and you may get a deduction for that also.
Great. Thank you, Joe. We're going to transition over to the tax assessor's office, and they're going to talk about personal property tax as it relates to small businesses. And then at the end, we're going to have some question and answer. So
let me just interrupt since you talk about personal property tax. All right. If you don't itemize your personal property for your house and your cars, if you itemize, it goes on there, and that's good. Also, On the Connecticut return, it's not much, but your personal property or your auto, if you pay more than $300, you can qualify for a $300 deduction on your Connecticut return. Okay, thank you.
Thank
Sorry
you.
for the interruption.
Nope, thank you. Take it away, Lynn.
Okay, I just had to unmute myself. All right. Welcome, everyone. My name is Lynn Ormsby. And again, I'm the Assistant Tax Assessor for the town of Trumbull, and I'll be presenting information to you about personal property declaration filing requirements, along with Rawan Shaham. She'll be available for any questions you have at the end. We only have about 10 minutes to present, so I'll be summarizing mainly the key points. The presentation is comprehensive, so it will be available to you on the Trumbull Tax Assessor's webpage after tonight, if you would like to go back and review it for more detail. There is a lot of information to take in, so don't worry. You can always reach us by phone, email, with any questions you have. It is also highly recommended that you reach out to a CPA or an accountant for any additional assistance.
And if you're not a Trumbull business, reach out to your local community, to your assessor's office, and I'm sure there's somebody there that can answer your questions.
Yeah. Okay, so let's begin with who is required to file. Basically, any business owner. So if you fall into any one of these categories listed here, you must submit a personal property declaration, even if your business is not actively operating.
So we're going to need somebody to move your slides, Lynn. Sorry.
Oh, okay. So I'm on slide 2. Is Gia handing it over to Rawan?
Yeah, I got the controls. You're good to go.
Great. Okay, starting on slide 2. So again, let's begin with who is required to file. So anyone who is a business owner is required to file a personal property declaration. So even if you're not actively operating your business, you just got it started, you bought a computer, you bought a cell phone, but you're not making any money at this point, you still need to file, as long as you've acquired those assets prior to October 1st. Some businesses that need to file are home businesses. Just some examples of that. Home businesses, businesses operating out of a space where they're leasing or renting are required to file. Next slide, slide 3. So what exactly is personal property? It includes goods, chattels, and effects. So basically anything that you own, it isn't land or permanently attached to land. It does not include inventory or personal belongings. So what are goods and chattels and effects? So goods are merchandise, items bought for use to conduct the business. Chattels are movable property, things that you own but you can move, like furniture, and effects are leasehold improvements. So if you lease a space and you fit it out to accommodate your business needs, that's a leasehold improvement. These are some examples of personal property that must be declared. Okay, next slide, slide 6. The deadline for filing is November 1st every year. Next slide. If you need more time to file, you can request an extension, but it must be submitted in writing by November 1st. When filing, you want to include all personal property used in your business as of October 1st, whether it's full-time or part-time. This includes actual acquisition costs, including transportation and installation fees, fully depreciated assets that are still in use, such as computers. Do not include disposed assets. Instead, submit a disposal detail sheet. If you acquired assets between October 1st and September 30th, report them as of the October 1st of the assessment year applicable. Okay, So there's basically two ways that you can file. It's either online or paper. Emailed declarations will not be accepted. At minimum, all businesses should fill out a class codes 16, 20, and 23. Latter, there's some slides that are going to be following this that will further clarify that for you. When filling out the general information section, you want to make sure that you're completing items 1 through 12. File separate declarations if you have assets that are located in multiple locations within Trumbull. Lesser's listing report. This section is for those who lease equipment to others. Lessee's listing report. This section is for those who lease equipment from others. This is basically disposal, sale, or transfer of property. This is, you would list what you've disposed of, sold, or transferred. If you need more sheets, then you can attach additional sheets. The value you want to report is the original acquisition cost, again, including transportation and installation. Used equipment should be reported as its original new cost and in the year that it was acquired, the assessment year that it was acquired. If the cost is unknown, estimate based on the current value and report it in the assessment year acquired as well. Include fully depreciated assets, again, that are still in use. Example would be computers. Okay. The next few slides are they basically discuss depreciation and what it is, how to calculate it, and how to calculate assessed value as well as mill rates, just to help you with calculating an estimated tax. Mill rates aren't established until June. So in the interest of time, we're going to move ahead, bypass those examples, and go to slide 23 to discuss more about reporting under the class codes on the form itself. If I can get to it. Okay. All right. So on this slide, you can see that the class code numbers are there and along with the class that it represents and the description. As you can see, codes, as we talked about previously, codes 16, 20, and 23 are the most common. And 16 is referenced for furniture, fixture, and equipment. Code 20 is electronic data processing equipment, so your computers and peripherals, printers. And code 23 would be supplies. This chart gives a sample representation of how you would code your assets. So you can see cell phone, code 16 goes under equipment. This is an example of how to complete the tables on pages 5 and 6 of the form. There are some exemptions offered, but additional applications are required. Make sure you file timely and use the correct form. It's important your declaration is signed. If someone else signs on your behalf, it needs to be notarized or possibly require a special statement. Penalties apply when you don't file, you don't sign, you file late, you don't file by the granted extension date, or we find undeclared property in an audit, field inspection, or some other means. The assessor is authorized to audit declarations within 3 years of the date required filing. Assessment notices are mailed by February 10th, unless an extension to sign the grant list has been granted, then it would be March. If you disagree with your assessment, you can file an appeal. Deadline is always February 20th, unless there was an extension to sign the grant list. Appeals must be fully completed, signed, and submitted with the supporting documents. Later emailed appeals are not accepted. If you're unsatisfied with the Board of Assessment Appeals decision, you can appeal to the Superior Court within 2 months. Here are some calendar dates to help you better understand the timelines. And here are key points to remember. So personal property filings are required for all business owners. Personal property must either be filed online or paper. It is not subject to prorations. So if you move your business out of town or dissolve it during an assessment year, there is no proration. 25% penalties apply for late filers, non-filers, unsigned forms, omitted property discovered during audits or field inspections and other sources. Assessment notices, they are not tax bills. They are just simply that, notifying you of what your assessment is. Tax bills are due July 1st with the option to pay in 2 installments, July 1st and January 1st. The assessor can audit filings within 3 years, including non-filers. If you disagree with an assessment, file an appeal by February 20th. And if you have any questions, you can contact us either, again, via email or our number directly. Thank you.
Thank you, Lynn. Great job. Bill, we're going to open up a question and answer period for both Joe and Lynn's team members. So if there are any folks that are in attendance that have questions for our tax experts, please raise your hand, and Bill Chin, our very, very good IT director, will let you in. Any questions?
Okay, yes, if you have any questions, please click the raise hand button at the bottom of your screen. Okay, we've got Miss
I think
Jacobs.
Bill, I don't know if you can hear me. There's a question in the chat. What
Yeah,
about
we'll
if you do business out of your home? What can you deduct?
Well, that business, that tax term is called home office, and there are certain rules for that. It has to be exclusive. And basically, you allocate the space for the home office. Let's say your house is 1,000 square feet, and the room that you're doing your business exclusively in is 100 feet. Okay, so that's 10%. So then you can deduct 10% of your electricity, your property taxes, and I'm trying to think of what else you would do from the home office. But the important thing is that it's exclusively for that. You can't, you wouldn't use that as a lounge room. You wouldn't have your personal TV in there. You probably have your computer for business. So it has to meet that test. You would probably meet customers there if possible. There's a short version of the home office. If you don't want to do all those computations, there's a short form home office deduction on the tax return, and you just give them the square feet, and it tells you what you can deduct for home office. So you don't have to go through and keep all the records for electricity and property taxes, real estate, mortgage, etc. You don't have to keep records for all that. Not too many people use a home office. If they need a separate space, a lot of them just rent an office outside their home. But home office is a tax area.
Has a question.
Is it Marlene? That's hands raised. Marlene Rossi. Can you allow her?
Miss Rossi's next, but Miss
Oh,
Jacobs
okay. Go
has the floor.
Oh, am I on? Hello. Hi, I have a small landscape business, plant design, and I am an LLC, but I constantly am hearing that an S corp would be a more cost-effective way to file. Is that too late if I make that switch? And can you explain that difference to me? And if I make that switch, I do not have any employees. So I'm a sole proprietor LLC.
Well, it's not, you know, A plus B equals C. You have to look at the specific dollars and cents and what's involved. As an LLC, basically you protect all of your personal assets, your house, your car, etc. If you switch to an 1120S, there's certain rules, and one of the rules is that if you're still going to be a single member, now you're a corporation. 1120S is a corporation, so you have to file corporate minutes and everything, and also basically you have to pay yourself a salary for your time and effort there. And if you have a gain or loss, it goes on your tax return. You don't pay SE taxes on the gain. But the important thing to remember is that you basically are going to be an employee of the 1120S. People with a lot of fixed assets, okay, would usually go to an 1120S. But it's not, it's not, you know, as I said, A plus B equals C. You can Google, you know, on your computer, and you can go, you know, LLC versus 1120S, and you'll hear some scenarios of why people did it, and see if you fit into that. If you want to schedule a session with a mentor like myself, we can, you know, look at the things and try to help you and push you in the right direction. The other choice is go to a paid CPA and see what's going on.
Thank you. And another question, and I don't know if I can have the floor for one more second. So when it comes to items like phones, trucks that I use for both personal and business, how do I navigate what is deductible?
The best way is to determine approximately how much time you use it for personal and business, and only you can determine that. All right. I mean, keep a diary, and make notes. Just document and do it that way. Like for a cell phone, as an example, we have people we do taxes with, and they have a small business. They have a cell phone, so you know. They have the cell phone. They pay it monthly, and we usually start with them and say, why don't we do it 50-50? Okay. Now, if you want to do it more, then you should have a reason why you want to do it. Some people have a cell phone and they use it exclusively for business, so that's definitely 100%. All right. I mean, if you got audited for a cell phone, which I seriously doubt, you know, how would they track whether 50-50 is wrong? Right. It's almost impossible. They have to get a list of your phone calls and usage for the whole 12 months. No one's going to do that. Right. Right. So start with 50-50, and then what you would do if you want to take more or whatnot, just have a good reason as to why you would do that.
Okay.
Same thing for the truck. Okay. I mean, most of our people who have small business, they use their personal auto for business miles too. So they keep a diary, and they have business miles and personal miles, and it has to be in writing in case you get audited. And they have it. Okay. And they just didn't make up the miles. They have a system, and they have a diary for it.
Right. Thank you.
Okay, thank you, Ms. Rossi.
Thank you. Can you guys hear me?
Yes.
Hi. Thank you. Thank you for the presentation, guys, and putting this together. It is a lot of information, and I must say I'm a bit more confused now than I was before, but I'm hoping to make it through this. I have a question regarding the personal property. We have a limo company in Trumbull, but we work out of our home. So is there a place where we could like see exactly how the property I forgot the exact terms, but how that property tax like what actually is included on there? I hope I didn't like jumble my words too much there, but I just don't know. I don't have a clear understanding of what to put on there, where to find it, when to do it. Like I just need a place that I could go and kind of like follow.
Yes, that's a great question. So, since you are conducting the business from your home in Trumbull, that you would be filing with the town of Trumbull. So you would have an office there, computers that you would use to schedule your limo rides, supplies such as paper and ink to be able to do the billing. So that would all be part of your assets as far as the limo business. And the limos, are registered vehicles, so I'm gonna have Lynn jump in there and talk about if those would be a part of your declaration or not.
The limos would be registered with the Department of Motor Vehicles, so that would be part of your motor vehicle tax.
Okay, so that's the one that I pay the DMV twice a year, right?
Yes.
Okay.
Well,
I'm new to
Well, that's the
Connecticut. I'm
taxes that
sorry.
you're paying.
yes, yeah.
Okay. Yeah, this is just all new. I'm new to the state altogether, so everything's very new to me. Okay. All right.
Does that help a
So
little bit with the?
it does. Yes,
Okay.
it does. It does give me an idea because I wasn't sure how to manage the cars and everything else. Okay. Thank you so much. I appreciate it. Thank you.
You're welcome.
You're welcome.
Yeah, if anybody else would like to make a comment, please press the raise hand button at the bottom of your screen.
So, Joe, I don't know if you mentioned this, but I just wanted to say, there's lots of different things that relate to your business that you can consider deducting, and you pointed folks in directions and gave them some ways to think about that. That was great. How about estimated taxes for small businesses? A lot of times I hear from our businesses that they didn't realize, and now they're getting, they're coming to the end of the tax year and they haven't set aside the money to pay their taxes. So I know when I ran my consulting practice out of my home, I did that for 5 years. I always estimated my taxes and did an advance payment. So oftentimes I would either get money back or I'd only owe a little bit. Can you speak to that at all?
Well, as we said before, you're a small business, you're not an employee, and you have to keep track of your own profit and loss, your income statement. So not all small business people are accountants. So normally they have to hire a bookkeeper or an accountant. Some small business people get QuickBooks, which is an online accounting system. And on a daily or weekly basis, they input all the data and they get a P&L monthly, profit and loss. So what you want to do, estimated taxes is quarterly, April, June, September, and December or January for the fourth one. So it's up to you to decide if you have a profit in the quarter. And again, if you have a profit, your estimated tax computation would be first 15.3% for the self-employment tax, and then approximately 20% more. Now, we can't tell what percent the should be because we don't know your whole 1040. You may have other income and whatnot, but a safety factor is that 15.3% plus 20% on the profit. And then hopefully, if you do that quarterly, now if you have a loss this quarter, you don't have to do anything for estimated taxes. If you do the estimated taxes, then hopefully when we do your taxes, you'll be in the ballpark there. You'll have a slight refund, or you may have some money to pay. We will say that both the state of Connecticut and the federal government, the IRS, they have a penalty if when you file your taxes, you owe more than $1,000, they can issue a penalty for that, and they will bill you for that. So again, the most difficult part, especially for I've had some people doing their tax return. It was the first time they did a Schedule C. They were formerly W-2 people, and they didn't do any estimated taxes, and they had a big bill, and they were shocked. And I said, listen, here's what you made. If you were an employee, you wouldn't have made that much because they have all the deductions. So basically, you're getting more money each month, but you're paying it at the end. It nets out to be the same thing. But of course, there's penalties that the state of Connecticut and the IRS can impose upon you if, when you do your taxes, you owe more than $1,000.
So it's really important for those folks who might be self-employed or running their own business to really, if you're not paying estimated taxes and you're making a profit through the year, to really get yourself on a schedule quarterly to pay your estimated taxes. Less surprises at the end of the year, just like Joe is saying. The other thing I wanted to say to the businesses is also, it's really important not to mix your personal credit cards, your personal bank accounts with your business bank accounts. Whether you have a checking account, credit card, or some other way, you should put all of your business expenses together and never use your personal accounts for your business. That can pierce your LLC and the protections of your LLC. The other thing it does, if you have a certain type of credit card or bank account, all of your, even if you're not to a point where you're running QuickBooks yet, you have a smaller business, you should get on QuickBooks, but if you're not, or something similar and you don't have, at least you have there a list in your credit card of everything you spent for that business, or in your checking account, everything that you spent for your business. But you should never use your debit card that you used for personal stuff when you're out at the store to pick up business expenses. Do not do that. That will put you in a situation if there's ever, in an unfortunate situation where you're getting sued or anything like that, you could really undermine the protections that your LLC gives you. And it also makes it much more difficult to track all of your expenses when they're all over the place on multiple cards and ways of paying for things. So that organization around your business is very important. I know when I had my consulting practice, I did just as you said, Joe. I had a home office, and it was approximately 200 square feet set aside for my office. I deducted that. I deducted a percentage of my internet for the, I deducted a percentage of my utilities for my home office. I know that I tracked certainly any training I took, any business trips I took. I know you can, I guess with your car, you can either do mileage, or if you're paying you can either do straight mileage, or you can do your repairs, your tires, all the other expenses to your car. Is that correct? You can do one or the other.
Standard mileage rate or specific identification.
Right.
Yeah, those are the two. The easier is the standard mileage rate, but there are some people that use the other method.
So for me, like, I had another car, so I could declare one of my cars, as my business expense. And what I did was all of my insurance, my auto repairs, I put new tires on my car, my gas for my business car, that ended up being more than my mileage. So depending on what way works better for you, but you just have to make sure that you're meeting, that threshold requirement, that it's relevant to the business, whatever you're declaring. I know that that was helpful for me because when you're making money in your small business, the taxes are significant on your profit. So write down what you can, and it's amazing. Another thing that I did was take, when I traveled, I had parking fees when I went to visit clients. I took all my parking expenses off, toll expenses, any kind of, certainly meals that I did. Sometimes I would bring a holiday gift to a client, nothing extravagant, but just a welcome gift to remind them of who I am. My business cards that I printed, any printed materials, all of that I deducted. My daughter has a tutoring business. She has a list of things that she buys books for her tutoring business every year. She takes refresher courses. She has to even wear a certain type of shirt and pants with her tutoring business. She took off the clothing allowance because it's a specific way that she dresses for her tutoring assignments. So, there's lots of things specific to your business. I think that the reason we asked Lynn on for the personal property is because a lot of people don't know about it and they don't file. You have to self-file, right? Meet these deadlines. And someone finds out you have a business, then the town can come in and assess your personal property, right? And you get all kinds of interest tacked onto it, that kind of thing. So it's better for you to do it, identify what's there, and so that you don't end up in a situation where you're paying 25% fines and penalties. We have had businesses, even small businesses that are in retail locations in our town, that did not understand they had to file personal property taxes. They thought that because they were paying nets, their triple nets, they were paying an apportionment of their actual property tax within a commercial. They thought they were paying all of their taxes that they owed as a business. They had no idea that they owed personal property taxes. And one of the particular businesses was a restaurant type business, a small locally run cafe type place. And, the town came in and did the assessment for them, and it was not small. And they then missed the window to appeal it. And then they weren't paying it. So that all adds up. And Lynn will tell you, an assessor's office can only forgive what's statutorily, they're guided, they're really controlled by state statute in a lot of ways, and they can't, they have to follow those state statutes. They can't just waive things or, come up with their own solutions to things. They have to do it within what the state statute allows tax assessors to do. So it's really important that folks, if you don't understand what personal property tax is, that you learn about it, because you may think folks won't learn about your business, but somehow something will come up that the town receives notice from a bank or a request, something, a neighbor calls, if it's out of your home, and somebody finds out you have a business there, and then they go look and say, have they been filing person? And then they haven't, and then they're in a jam, right?
I would like to add that this is not just that this personal property filing is not just a requirement for Trumbull. It is a requirement for all 169 municipalities in Connecticut. The only difference between what you would file here and maybe in another town would be maybe how an assessor would determine the exemption is or is not approved. And where the asset we would actually file. So if you don't have assets located here, you would be filing where they are located. But I want to make sure that is very clear, that taxpayers are understanding that this is not a Trumbull thing. It is a statewide initiative.
Right. And if you're out of state, you have to, there's different laws state by state, but I think most of our attendees are either local or within Connecticut. So are there any other questions from
Well, I'll
people?
just underscore what you opened up with, that when you start a business, separate personal from business. So open up a business checking account, do all your revenue deposits there, pay as many bills as you can there. If you have a credit card, use one exclusively for business. And it makes life a lot easier for you in terms of doing the bookkeeping. Thank you.
Are there any other questions? I see in the chat, I just want to check. Various property taxes, who in Connecticut to talk to. You would talk to the assessor's office in your town. They would handle your real estate taxes, your motor vehicle taxes, like the limo driver business. Her limos are taxed on her motor vehicle tax bill, so they're not part of her personal property tax. And then your assessor would also talk to you about your personal property tax. And all these things, as it relates to your personal assets or your business, there's different rules that apply based on your business and what you own and that relates to your business. I hope that answers your question. It's under anonymous, so. Are there any other specific questions that we can try to answer for you? We're going to send you all of the documents you saw on the screen. Everybody who's registered and everybody who attended here will get all of the documents. It'll be posted numerous places. Joe has offered to do through SCORE some more one-on-one business counseling. So he gave you, and it will be on the documents that you receive via email, his contact information. Lynn and her team are available if you're a Trumbull business and you want to get ahead of this process because your filing's due in November and you want to understand it better. They're there to help you. If you're from another town, call your town's assessor's office in advance so that you don't end up in a problem. Okay. So with that, we want to thank you all for being here. Thank you for running your small businesses. They're really the lifeblood of our communities. We want you to succeed, and we wish you the very best in your business this year. If I can help you out of the Economic Development Office or Gia Mantillo, my assistant, we're here. We have lots of resources. If you're not registered with our office and you're a Trumbull business, please do. We hold free events all year, networking. I do one-on-one business counseling as well. Okay. So thank you all. Have a wonderful night. And thank you to our panelists. You've been superb. And I want to thank Bill Chin, our IT director, who is always supporting us in so many ways. Thanks, Bill.